The stock market can be a very tricky place, and there's a lot of rookie mistakes that beginners constantly make that hurt their portfolio, but most importantly, their investment returns. Some of these mistakes literally cost some people hundreds, if not thousands of dollars. And in this video, I'm going to be talking about some of the most common beginner investing mistakes, how you can avoid them, and how I can save you some money. Let's begin. The first mistake beginners make is trying to get rich quick by day trading. The stock market nowadays seems more like a casino than a wealth-generating tool, hence why day traders are trying to profit off promises of high returns. Studies have shown that 80 to 97% of day traders actually lose money over time, and less than 1% are actually profitable. How day traders try and make money is by buying and selling stocks in a very short window of time. We're talking minutes or hours during the day in hopes of turning a profit. The problem with day trading is that it's extremely risky, and it's impossible to predict which direction these stocks will move throughout the day, because one wrong guess can lead to hundreds if not thousands of dollars lost on a single bad trade. Now, you might win a trade or two here and there, but chances are you'll leave broke and disappointed. Listen to me, when you're day trading, you're not investing, you're gambling with your money. It's reckless, it's risky, it's extremely unpredictable, and it's simply not worth your time. Now, you will have more success and money by investing in a broad market index fund or ETF that tracks the S&P 500, which I constantly do, shown on your screen. Now, the second common investing mistake is investing in meme stocks. There's a good chance you've seen the term meme stock splashed around headlines this past year, even if you aren't following business news. A meme stock refers to a select few stocks that gain sudden popularity on the internet and leads to sky-high prices and unusually high trading volume. With these high price swings, meme stocks can be extremely volatile and extremely risky. A meme stock's value is a result of its hype on social media and not necessarily the company's performance. Though there is the potential for high gains, meme investors are more likely to experience bigger losses as the stock price becomes overvalued and the price drops dramatically. For example, GameStop went from almost $1 per share to over $81 per share, which is a 7,000% gain. But now it's down to $19 per share, which is an 80% loss if you invested it at the peak. With meme stocks, you'll never know when to sell, and though it may be exciting to invest in the stock now, there's no telling how long the popularity could last. A third mistake I see new investors make is trying to time the stock market. We don't have crystal balls. Even the best stock investors on Wall Street today can't predict where the markets or stocks are going to move. Looking at data going back to 1930, Bank of America found that if an investor missed the S&P 500's 10 best trading days each decade, the total return would stand at 28%. If, on the other hand, the investor held steady through the ups and downs, the return would have been a staggering 17,715%. The best way to avoid timing the market is going to be dollar cost averaging, and how you can properly dollar cost average is to continually invest in the market on a regular basis regardless of the share price. Fun fact is the market's best days typically follow the largest drops, meaning timing the market can lead to missed opportunities on the upside. The fourth mistake I see new investors make is failing to diversify. While professional investors may be able to generate a return that outperform the markets by investing in a few concentrated positions, common investors should not try this. Often investors think that they can maximize returns by taking a large investment exposure into one stock or sector. But when the markets move against such a concentrated position, it can be disastrous. For example, some beginner investors fell in love with Snapchat stock when IPO'd and threw most of their money allocation into Snapchat stock. If you bought Snapchat stock, you would have been down over 63% in the past year and down over 23% in the past 5 years. If you diversified into an ETF or index fund like Vanguard's S&P 500 or total stock market, you would have been down only 7% in the past year and up over 45% in the past 5 years. Now, it's important to allocate exposure to all major spaces, but as a general rule of thumb, do not allocate more than 5 to 10% to any one investment. Now, the fifth investing mistake I see new investors make is investing because stocks are going up. Now, this is a common misconception because you should be really excited when stocks are going down, not necessarily when they're going up. It's hard to understand this, but when everyone is talking about the stock market going up and trending to all-time highs, that's usually not a great time to invest. If you want to make a lot of money in the long run, in the early days of your investing journey, you want the stock market to go down, and I mean go down a lot, because you want to get a lower entry point which will amplify your returns. As Warren Buffett says, be fearful when others are greedy, and greedy when others are fearful. When others are greedy, prices typically boil over, and one should be cautious if they overpay for an asset that subsequently leads to poor returns. However, when others are fearful, it may lead to a good investment opportunity, which can lead to great returns in the long run. The sixth rookie mistake I see new investors make is investing with margin. When you buy a stock on margin, you're taking out a loan from your stockbroker and using money that isn't yours. When you use margin, you're technically using stocks as collateral, and while this may improve returns during favorable times, there's a potentially catastrophic catch that has even snared the smartest investors, where they lost more money than they initially invested. Now let's look at some of the biggest trading losses on margin, mostly posted on Reddit. So this one on your screen says down $57,989, or almost 2,000% on the year. That's pretty awful. Second one says down $44,000 in account deficit. That basically means you spent more buying power than you had. The last one says down $165,000 by using your Robinhood Gold. Don't use money you don't have, guys. And last but not least, the infamous Apple earnings trader, down $40,000 or 500%. Pretty sure you guys could look this one up on YouTube. This guy pretty much lost all his money betting on Apple earnings within about 5 seconds. Now, the last mistake I see new investors make is not investing with the long-term mindset. In most cases, investing with a short-term mindset does not work reliably, but what does work reliably is investing with a long-term time horizon, because this will minimize your chances of losses. Now, if you invest with a time horizon of longer than 10 years, then so much of the stress of investing just simply goes away. Because if you are committed to a long-term investing strategy, when the markets go up, you win. When the markets go down, you also win. Because when the market goes down, you're being handed an opportunity to make more money in the long run, because market crashes equals greater long-term returns. It's easier said than done, but stay strong during the downtimes and always have a long-term mindset. Now, with all that said, those are my top beginner investing mistakes that people make, and I hope you guys found some value in this video, and I hope I saved you guys some money and some pain. If you enjoyed this video, please do subscribe to make your investments go to the moon, or if you want to see more content like this, please leave a like on the video and comment down below an investing tip that I might have missed. I hope you guys have a great day, and I'll see you guys next time.